All right, let's get straight to it. The market is coiled. We've got a technical bounce fighting some pretty ugly macro data, and a resolution is coming, fast. This is the tactical framework for the next 1 to 2 weeks. So, here's the core debate on every trading desk right now. Was that pullback we just saw a sufficient shakeout to clear the deck for a run higher? Or was that just phase one of something much bigger to the downside? This is the central conflict.
My thesis is simple. The market is tightly coiled. You have a technical bounce that's running right into a wall of deteriorating macro data. This tension cannot last. We have key catalysts on deck that are going to force a resolution. The sideways action is about to end.
So let's break down the conflicting evidence. It really is a market divided against itself right now.
You've got two completely different stories playing out. The bulls, they're pointing to the technicals. Key support levels held on the dip, and hey, seasonality is a powerful tailwind this time of year. But the bears, they're looking at the real world. Macro data is getting worse, market breadth is collapsing, and valuations are, frankly, extreme. It's a real tug-of-war.
Let's dig into that bear case, because the underlying weakness is serious. You have job cuts spiking to levels we have not seen in 2 decades. U.S. household debt is sitting at record highs. Student loan defaults are reportedly exploding. And consumer sentiment, it's circling the drain at the second lowest level ever recorded. That is not a recipe for a healthy market.
And this right here, this chart shows the divergence perfectly. The big indices look fine on the surface, but it's a mirage. It's all being held up by a handful of mega-cap names. When you look under the hood, broad market participation is just abysmal. It's like a general leading the charge with no army behind him. That's a very vulnerable position. And check this out. We've reportedly seen 5 Hindenburg Omen warnings in a very short period. Now, for those who don't follow this, it's a pretty serious technical red flag. It basically means the market is near its highs while tons of individual stocks are hitting new lows at the exact same time. It's a classic sign of extreme instability under the surface. And let's talk valuations for a second. The Shiller PE ratio is higher than it has been 90% of the time. Let that sink in. 90%. Stocks have only been more expensive than they are right now for 10% of modern history. It just screams that long-term value is not here at these levels. Okay, so this tension can't last. Something has to give. Let's look at the catalysts that are about to force the market's hand. All right, put these on your calendar. 3 key volatility events. First, this Thursday, core CPI. That's going to move the needle on Fed expectations. Then, November 19th, NVDA earnings. This isn't just about one stock. That report can move the entire market. And in the background, you have the constant headline risk from government shutdown negotiations. All of them are major potential movers. So enough with the what. Let's get to the how. Here's the game plan, based on an if this, then that framework. Okay, here are the scenarios. It is all about the moving averages right now. The 10-day is your short-term trend, the 50-day is your medium-term line in the sand. For the bull case to play out, we need to see SPY and QQQ reclaim and hold above that 10-day. If they fail and get rejected there, that's your bear trigger. Our base case, just more chop between those two levels until one of them breaks decisively. Just a quick pause here for the mandatory disclaimer. This content is for educational purposes only. It's meant to aggregate public information to help you stay informed and improve your own decision-making. Please do your own research. This is not financial advice. And one more thing, if this analysis is helping you navigate things, please take a second to hit that like and subscribe button. It really does signal the algorithm and helps the channel reach more people. Your support is seriously appreciated. All right, let's move from theory to practice. Here are a couple of defined risk setups for tactical execution. First setup, NVIDIA, ahead of that November 19th earnings report. This is a massive market catalyst, and the thesis is simple. Exploit the predictable rise in implied volatility that always happens leading into this kind of event. So how do you play that? Well, one potential structure is a long strangle, or straddle. The rationale is to get long volatility. You're betting on a big move, and you don't really care which direction it goes. You just need that IV spike and a post-earnings move that's bigger than what the market has priced in. The risk, of course, is if IV fails to expand or the move turns out to be a dud. Okay, second setup. This one is different. It's a quality pullback play on TSM. The thesis here is to sell premium on a high-quality name. I mean, a 45% profit margin is just incredible at a key technical support level, which is that 50-day moving average. The strategy here is selling a cash-secured put. The goal is to collect premium while establishing a desired entry point at a lower cost basis. You'd target a strike price below that 50-day moving average. Best case, you just keep the premium. Worst case, you get assigned shares of a fantastic company at a price you were willing to pay anyway. Your max loss is limited to that strike price minus the premium you brought in.
And I have to be extremely clear here. Options trading involves substantial risk. Your capital is at risk. Losses can exceed the premium you pay, and it is absolutely not suitable for all investors. You must employ disciplined sizing and use stop losses. So I'll leave you with this final thought. The market is coiled this tightly. The move is coming. The question you have to ask yourself is your portfolio positioned for the resolution, or is it set up for the whiplash?
And remember, this is not trading advice. It's a market update to keep you informed. All markets carry risk. Trade your plan, manage your downside, and always, always verify all data for yourself.